How do family businesses navigate complex tax on ownership transfers? Imagine passing down a family business to the next generation without losing a big chunk of it to taxes. That's what many family businesses aim for when transferring ownership shares. When owners decide to pass on their shares, they face many tax rules that can make the process tricky. The key is understanding how different transfer methods impact taxes and planning ahead. First, owners can sell their shares, but this usually means paying capital gains tax on the profit. For example, if someone bought shares for $50,000 and sells them for $100,000, they owe tax on the $150,000 gain. Gifting shares is another option. It can avoid immediate income tax, but the giver might face gift tax if the value exceeds certain limits. The annual gift tax exclusion allows giving up to $15,000 per person each year without tax, and the lifetime exemption is over $12 million. Many family businesses use trusts to transfer ownership while keeping control and reducing taxes. Trusts like grantor-retained annuity trusts or intentionally defective grantor trusts let owners move shares to heirs with less tax impact. These trusts need careful legal setup and expert advice to follow the rules and get the best results. Another common strategy is installment sales. Instead of a big lump sum, the seller receives payments over several years. This spreads out the capital gains tax and can keep the owner in a lower tax bracket. For example, selling shares over 3 years can reduce the tax burden compared to a single sale. Some businesses use special installment methods, like 2-year installment sales, especially in agriculture or family farms, to delay taxes even further. Adjusting the basis of assets is also helpful. This means changing the value of shares or assets before selling, which can lower the taxable gain. For example, in partnerships or limited liability companies, owners can allocate higher bases to certain assets, reducing the capital gains when sold. Deciding between gifting and selling involves trade-offs. Gifting can lower estate taxes by removing future appreciation, but the recipient inherits the original cost basis. Selling gives the owner cash now but triggers immediate taxes. It's important to weigh these options carefully. Throughout this process, professional advice from tax and legal experts is essential. They help value the business accurately, structure transactions properly, and ensure compliance with laws. They also help align tax strategies with the family's goals for succession and wealth preservation. In the end, family businesses successfully navigate these complex tax issues by choosing the right transfer methods, using tax deferral strategies like trusts and installment sales, adjusting asset bases, and working closely with professionals. This careful planning helps keep the family's wealth intact, ensures smooth ownership transitions, and supports the long-term success of the business.